and welcome to MF Basics. I'm Lisa and you're watching episode 5 where we are talking to you about hybrid funds. In the previous episodes, we spoke about equity schemes and how to choose them, debt schemes, how to choose them, and now it's the turn of hybrid schemes. Okay, so let's think about it. If you think of a hybrid car, it can be driven on battery or it can be driven on fuel. So hybrid funds are pretty similar. You can drive returns through two different assets. It could either be equity or it could be debt. They are both present in the fund, right? Now, SEBI, just like it has defined categories for equity and debt schemes, it has also defined categories for hybrid schemes. There are 7 different categories, right from aggressive hybrid, balanced hybrid, conservative hybrid, then there is multi-asset, there is dynamic asset allocation, and there is equity savings fund and arbitrage schemes. So the main difference in all of these different categories is the different proportion in which equity assets are present and debt assets are present. In the multi-asset category, of course, there is inclusion of gold as well. The idea is behind a hybrid fund is that at any given point in time, one of the assets will actually drive returns. When equity markets are doing well, it will be equity. When fixed income returns are high, then it will be fixed income. However, the different categories show us that there is a leaning to one asset and the risk return profile hence will be towards that. So an aggressive hybrid fund will have about 60 to 70% invested in equity. So if markets crash, your hybrid fund will also give you a negative daily return because it has 60-70% in equity, and that's a lot, and the debt portion will not be able to cushion it on a daily basis. Over a period of time, of course, it will change. Similarly, in a conservative hybrid where only say 20% is invested in equity, if the markets crash, your fall in returns will be limited. Could be there could be an impact, but it will be limited, not as much as your aggressive hybrid. Now, think about why you would want to invest in a hybrid fund. So earlier, the risk return dynamics were quite simple. There were 2 large categories. There was the aggressive and there was the conservative. The aggressive was used to get equity-like returns and the conservative was used to get kind of regular income. Now there are many more variants, so there's a lot more choice and you have to be careful about what you're getting into. Now, when we say that hybrid fund is a combination of the 2 assets, how do you know which combination suits you the most? Well, you don't really know. So these hybrid funds were being used up till recently for regular income, even from the aggressive hybrid as dividend. And that practice has slowed down now because dividend taxation has become unfavorable. But a lot of people were investing in aggressive hybrid funds for kind of assured dividends. And we have seen the assets under management of hybrid funds grow substantially. In fact, there are schemes which have 20,000 to 30,000 crores in single schemes. So they are quite popular with investors. But let's dig a little deeper. What happens is that because of the choice and because every individual's need for fixed income assets or equity assets really depends on your goals and not how the market is doing, it becomes difficult to choose a hybrid fund simply because of the asset allocation or the different proportion of different assets in it. Hence, the regular income kind of lure was a good lure to get investors in because hybrid funds typically will have slightly lower risk compared to a pure equity fund. At the same time, you're getting regular income. So it's a win-win. Now, this, of course, did not work out when the market crashed so sharply in March. And people are now realizing that hybrid funds cannot be relied on only for regular income. There has to be a higher rationale to invest in them. And when you have access to pure equity and pure debt funds, then, what is that rationale? There is one subcategory which actually makes a lot of sense, which is the dynamic asset allocation category. A few of the funds in this category have done well, and in fact, one of the schemes is a huge 26,000 crore scheme where a lot of investors have put their money. What dynamic asset allocation funds do is change the proportion invested in equity versus the proportion invested in debt based on the market on a very active way. But what you don't know is which metrics the scheme is using. And some schemes will use a P ratio to decide how much to invest in equity and how much to invest in debt. Some schemes will use a price to book value ratio to understand the valuation of the market. No scheme uses just one metric. Of course, there are 3-4 metrics and a combination of that. But what I'm getting at is that for every dynamic asset allocation scheme, there is a different set of valuation metrics which are used to arrive at the proportion of equity that is required in the scheme at a given point in time versus the proportion of debt. If you look at the set today, there are 6, 8 or 10 different dynamic asset allocation schemes. Not only are the returns in a very big range from -10 to 20%, but also their equity allocations vary from, say, a 40% to an 80%. So which one are you going to choose? It requires you to go into the scheme information document. It requires you to understand how the returns of every single dynamic asset allocation scheme have matched different market cycles and what the mandate has done in different market cycles. So you do need to get into all those details, and that requires a lot of work. What you get at the end of it is perhaps a 2% kind of premium over your fixed income, short-term income fund kind of returns in the long run. So these, in my opinion, are not really long-term products. Maybe in volatile markets, you can allocate a little bit, but otherwise you really have to think about hybrid funds and what purpose they are serving for you. If you have access to pure equity funds and pure debt funds, and you can combine them in a manner that is best suited for your financial objectives and make a customized hybrid portfolio, then do you really need anything else? Let me leave you with that thought and hope to see you in the next episode, episode 6, where we will be discussing even more things mutual funds. Thank you for watching. I'm Lisa.